Welcome back to EG Financials. Today we're taking a look at the updated numbers for the real estate market forecasts. And we'll start off by taking a look at Mortgage Bankers Association, and then we'll take a look at Freddie Mac's commentary. So Mortgage Bankers Association goes all the way out to 2024, 2025, and 2026 when they're looking at volume for the real estate market, home price predictions, and the 30-year fixed rate. And let's start off by taking a look at home sales. So in 2023, home sales were about 4.1 million. For 2024, they're expecting an increase up to about 4.4 million. And then in 2025, we'll see a bigger jump up to 4.85 million. And then in 2026, we'll see total home sales be around 4.93 million. Next, let's take a look at their projections for home prices. So here we can see that 2023 is expected to end the year with a 5.7% increase in home prices. Then in 2024, they're expecting it to increase 4.1%. In 2025, an additional 3.3%. And then in 2026, about 4% increase in home prices. And lastly, for Mortgage Bankers Association, let's take a look at their projections for the 30-year fixed rate. So in 2023, they're expecting mortgage rates to be at about 7.5%, 2024, 6.1%, 2025, 5.5%, and in 2026, down to 5.4%. Okay, let's continue on to Freddie Mac. They have some great commentary regarding the real estate market and the health of the economy. I made some key highlights in their report. Economic growth remains strong in Q3, primarily due to solid consumer spending. We expect the economy to slow down as the full impact of higher interest rates is felt. Housing continues to reel under the impact of higher mortgage rates, with the resale market stalling to the lowest levels in 13 years. The labor market is showing signs of moderating as the economy added fewer jobs than expected in October at 150,000 jobs compared to the expectation of 190,000 jobs. The unemployment rate ticked up at 3.9% in October, the highest rate since January 2022, as did the number of unemployed persons, which increased to 6.5 million. The labor force participation rate as well as employment to population ratio were relatively unchanged at 62.7% and 60.2% respectively. Despite slower job growth and the uptick in unemployment, the overall labor market remains strong. The ratio of job openings to unemployed persons continues to be relatively high at 1.5 as of September 2023. While inflation has been trending lower, the annual growth rate remains well above the Federal Reserve's longer run goal of 2%. In the press conference following the November Federal Open Market Committee, the FOMC, Federal Reserve Chair Powell said that the process of getting inflation sustainably down to 2% has a long way to go. Higher rates and tighter financial conditions are also starting to impact consumer credit performance, particularly for credit cards. Credit card performance has been deteriorating, with approximately 8% of credit card balances transitioning into 30 or more days delinquent, while almost 6% of credit card balances transitioned into serious delinquencies. The uptick in the delinquencies for auto loans have been more modest, with around 4% of auto loan balances seriously delinquent and only a 12 basis point increase in the transition to serious delinquency from 2.4% to 2.5%. On the other hand, mortgage performance remains pristine, with the share of loans delinquent and those transitioning into delinquency very low as compared to other loan types. The outlook. We expect U.S. economic growth to decelerate in the fourth quarter of 2023 and remain tepid throughout 2024. Slower economic growth will result in slower payroll employment growth and an uptick in the unemployment rate. While the economy will avoid tipping into a recession, slower growth and weaker employment will dampen consumer spending. Inflation will continue to moderate but remain above the FOMC's 2% target throughout next year, and monetary policy will remain restrictive. We expect the recent volatility in treasury yields to abate, which will allow modest reductions in mortgage rates. However, mortgage rates will likely not fall below 6% in the short run, as a higher for longer narrative holds true. This is interesting. This aligns with Mortgage Bankers Association's forecast when it comes to mortgage rates. They're expecting next year to be about 6%, and then a couple years for it to reach down to 5.5%. Let's see what Freddie Mac is expecting for home prices. Elevated mortgage rates and a slowing economy will present a challenge to the housing market. Home sales will remain near current levels, and inventory will not increase substantially as the mortgage rate lock-in effect keeps existing homeowners locked into their current residence. Favorable demographics will keep the share of first-time homebuyers elevated, with limited inventory. Upward pressure on home prices will remain. In this scenario, house prices will rise nationally, increasing 5.4% in 2023 and 2.6% in 2024. All right, so Freddie Mac is expecting mortgage rates in the near term to be about 6% and home prices to increase in 2023 by 5.4% and in 2024 by 2.6%. So let's compare that to Mortgage Bankers Association and see how it compares. So Mortgage Bankers Association is a lot more optimistic when it comes to home prices. They're projecting 2024 to increase by 4.1%, while Freddie Mac is only expecting an increase of 2.6%. So again, like previous months, I do track about 5 or 6 different institutional forecasts for the real estate market. So once they're all released in the next couple of days, I'll go ahead and consolidate them and we can review them together in an Excel file. So make sure you follow for more updates.